Markets at record highs. Our guest says, sure, there may be further rate cuts this year, but they could already be priced in. Colin White joins us now, President and CEO of Verecan Capital Management. Colin, thanks very much indeed for joining us.
Well, thanks, Andrew. Thanks for the invite.
When you look at markets hitting record highs again today, do you feel that we're headed for disappointment here? I mean, the second half of September historically can be rough, for example.
Well, there's disappointment in our future for sure, but this marks 2 times I've been on the show. The market has rallied and done very well, so I think I'm probably the best leading indicator. You know, watching the news unfold, you had the visa news come out of the U.S., which was kind of negative, but markets seem to have shrugged that off. NVIDIA continues to be active, which is good to see, and 25% of the time the market trades at all-time highs. So this is part of what we have to go through. There's some things to be afraid of, and there's some things to be confident in, but the global economy seems to find a way forward.
Right. So you're saying that about a quarter of the time the market's at a record high anyway. I guess inflation means it does tend to go up over time.
Well, absolutely, and markets have mirrored that over time for sure. So we sometimes forget, how we have to be scared in order for things to move forward. And listen, there's all kinds of positives that we've overcome in the last 5 years from a global economic perspective, and we have our headwinds right now for sure. But we've proven to be very resilient. We're still waiting for the Great Recession of 2023 to hit, so we've already dodged one bullet. So yeah, there's lots of reasons to be confident. Things are getting a little weaker. We're seeing some negative numbers in the job side of things, which has our attention. Fewer people working, making less money. That is liable to hurt consumption. And in Canada, from a domestic perspective, we are struggling with higher default rates, things of that nature. So there's some things that indicate there's going to be a bit of a slowdown, but there doesn't seem to be anything really huge. And there's the old expression, don't fight the Fed, and they have chimed in and made their rate cut. So I think maybe we're riding that wave a little bit right now.
Oracle stock ignited just a few days ago on signs that they are making real progress in AI, but you question some of these massive moves.
Terrifying. When you get to the top, I mean, Andrew, you're of a vintage similar to mine. We remember back to the Nortel days, right? When the tech giants of the past have gotten high and started making big moves. Very exciting, and we hope they stick the landing. But at a certain point, they may fly too close to the sun. We think from a portfolio perspective, we do have index exposure, but we're also looking to maybe reduce our exposure to some of those most highly valued pieces of the market. It's very frothy. It's very easy to get attention right now, and it's very easy to find a buyer and a believer. But again, the music is going to stop at some point, and I think it's going to be more important to be in the right seat when the music stops rather than trying to chase it right to the top.
One area of the market that interests you right now is healthcare. What particular facet? Pharma stocks or health insurance, for example?
This is probably more on the pharma side, but if you take a look, it's trading at a discount equal to where it was back in 2008. So they're trading at a discount to the market and a discount on a valuation basis that almost hasn't been seen. Now, again, these are largely healthy companies and they're going to survive, but they do have some headwinds right now. I mean, they're dealing with tariffs and they're dealing with policy decisions, but these are big, profitable companies, and they're going to exist. So what we've been sifting through is trying to figure out where the winners are going to be, or where the survivors are going to be. It's odd. I mean, the markets, again, everybody wants to talk AI and how great the top end of the market is going, but you start sifting through some of these other very powerful companies, and there might be an opportunity there. When everybody's looking somewhere else.
What do you have thoughts on health insurance? It's had a rough year. I mean, without talking about particular companies, United Health, for example, UNH has slid this year.
It's probably more exposed to policy, and policy is abnormally random right now. So yeah, it's a super tough one to try to take a position on. Again, policy announcements seem to be coming fast and furious, and seemingly somewhat random. So it'd be very difficult to establish a position right now with a lot of confidence, which is why, again, we tend to look more at the broader sector rather than picking individual names. It's one way of managing the risk of things like that, especially where you have a policy risk, something that is something that's completely outside the market. those ones are very, very difficult to have a lot of conviction on and be right. It's very difficult to find an investing opportunity there.
The public REITs, you reckon, are showing signs of lagging the private market in terms of valuations. So that's catching your eye. Is there a particular type of REITs, retail, office, warehouse?
It's right across the board, and this goes back to earlier. I mean, we're seeing, the unemployment numbers are picking up, job market's getting weak, insolvencies are up. The banks are still having quite high numbers for defaults on their books. So the problem with the entire real estate sector is you don't get really active price discovery. So you have a lot of people holding on to things, keeping things off the market. But we do think that there's some more pain to be had there, and we haven't been big fans of real estate right across the board for a long time. But again, this is where we're spending our time, trying to find the opportunities in some of these sectors where you have really powerful businesses that, when they survive, they're going to do quite well. But it's a little early, but we are looking very closely. We want to see a little bit more underperformance. And again, taking a look at what's happening on the private debt side a little bit. There's some gating going on. So there's some pain in that market. So we don't think that the pain is big enough yet, but we are watching for the pain to develop, and hope there could be an opportunity. I shouldn't say hope. That's mean. We think there's going to be an opportunity going forward.
I guess Schadenfreude can be excused in investing. I mean, if stocks go down, somebody's hurting, but it gives you a bargain anyway. We better jump. Sorry, Colin. Thank you very much indeed for joining us. Colin White, President and CEO of Verecan Capital Management.